Hi there, it's Keith here from redboxfinancial.com. I just wanted to talk a bit about what factors you have to put in place as you grow your company in order to grow faster, grow larger in a safer way. And if you don't put these into place, you could be exposing yourself to massive risk of the company stagnating or even possibly going insolvent in the future. So what are these three aspects you need to be aware of? Well, they're normally performed by in a large company, they're performed by different people, different departments. Obviously, when you start off, you might even be a one-man band, so you're doing everything yourself. But as you grow, you need to at some point get other people involved to help you with these three areas, these three pillars of a healthy and thriving company. So let's go into it. First area, of course, is CMO, Chief Marketing Officer, who deals with branding, marketing and sales, all incredibly important, the driving force of your company. Then next, there's COO, Chief Operating Officer, and they'll be responsible for the operations and delivery of the goods and services. Equally important. You obviously need these two. Now, some companies make the mistake of only having these two because it might seem at first the company can survive okay just with these two, so why incur extra expense? But I hope to demonstrate here the advantages of having the third pillar, which is Chief Financial Officer. So let's get into that. There we go, CFO. So there's two different aspects of what they do. One is awareness of present, also including past and future finances, awareness and control. The other thing is just being present at an executive level and helping you with those functions, which I'll get into in a bit later on. So first of all, awareness of present and future finances. Why is that important? Why can't you just look at the bank statement? It's massively important. So a lot of people don't realise this or why. So let's get into this. So let's close some of these down. Okay. Clarity on the present and past. So hopefully you have monthly management accounts already, which present your situation at this moment and also historically how you've performed over last month and previous months. Many companies don't even have this, so if you have that, you're one step ahead of the game. Congratulations. But there's different ways this can be done, and also a lot of people take shortcuts, which means that the information presented in monthly management accounts is basically useless. So you have to know what you're doing and get someone at the appropriate level of expertise. So first aspect, of course, is the P&L account, profit and loss account. And there's four main metrics in this. The turnover, this is what most people focus on, which is a mistake, because it's, oh, I've doubled my turnover, or turnover's gone up. It doesn't matter if the way you're getting the turnover to go up is by decreasing your GP margin, you could be making a loss. So turnover by itself is nothing. So the next thing is GP percentage. You have to keep that at a sufficient level to make sure your GP, your gross profit, is healthy. Expenses, of course, you need to keep a tight rein on. In any company, in any household, it's so easy to let expenses get out of control. There's always pressure on you from other people to pay more pay to people, pay more for your office, or pay more for the goods that you may be buying to resell. All sorts of everything you spend your money on, there's pressure for you to spend more of it. So you have to keep control of this very carefully, but also make sure that doesn't impact your turnover or GP percentage. So it's a bit of a balancing act, and at some point it's just going to get really complex to really keep your eye on this and really control what's going on. So that's why you might need help by myself, my team, my software and so on to help give you the information you need to do this very effectively. That's just one aspect. Balance sheet is also important. Even if you make a fantastic profit, you can still go bust if you run out of cash. So the balance sheet shows your assets and liabilities. So maybe you've got a lot of your working capital tied up in stock or in debtors, and you need to get that into cash. So obviously you need to sell the stock to get into debtors. Then you need to collect the money from the debtors to get it into cash. So some large companies have a whole department of people in their credit control department getting the money in. You might not have that, but you still have to make sure you monitor the debtors, the debtor days, and take action when people are paying you too slowly. Likewise, it can sometimes be possible to delay paying your suppliers if that does not have any adverse effect. And also sometimes it's appropriate to look for outside forms of finance, maybe business loans or other investors or private equity or so on to help you grow. So that's all covered by the balance sheet. Bookkeeping can always be improved, and I personally have been shocked. I go into a lot of companies, look at their accounting software, and I'm often quite shocked really at what a mess it is, because you can't blame the people doing it. You don't know what you don't know. They just do what they've always done. Maybe they don't have the right professional qualifications, or maybe they haven't been trained in the right way. But a big problem I see is not doing a proper monthly cut-off. So you might have sales in July relating to cost of sales in June, and according to a fundamental accounting principle, the accruals method, they should be matched off in the same period. So you should do a prepayment to accrual at the end of June to bring them into the same period to match off the sales and cost of sales. But I'd say most of the SMEs I've seen do not do this. So it means if you look at their accounts, their profit, it goes like that, and the reason is not because they're making more profit in that month than in that month, but it's just because of the timing differences, because they don't match things off properly. So this is one of the first things that I would help put into place, so you can really get a sense of, are you making profit, are you making a loss? Because otherwise, if you don't do this, you don't really know, and it might be months and months could go by and you're making either a loss or very little profit and be totally unaware of it. And then if you go to the next stage, there's many other things we can do. Different ways of analysing data. Maybe you have projects. If you have projects, then you have to look at the profit per project. Also, if salespeople look at the profit each salesperson brings you, all sorts of things you can track, so that you can aware if there's people or departments or products which are underperforming, and then you can try and fix that, or if you can't, then invest more of your money and resources into the areas that are doing well and less in the areas which are not doing well. And we'll also use pivot tables to make sense of all the data somehow. So this is all clarity on the present and the past, which is incredibly important. Lots of people don't even do that, but that's just part of it. Even more important is to focus on the future. It doesn't matter if you've done incredibly well in the past if you're exposing yourself to risk or decline in the future. And obviously you want to grow, you want to thrive, and you want your business to do very well in the future. So this is why you need to focus on it. Things like this don't just happen by accident. Step one is to set goals and have some method of accountability for those goals. And then the goal could be, for example, to double your turnover in the next 2 years. So to do that, then you create, or we create, a forecast to do that, which could be partly a cash flow forecast, could be a 5-year forecast, which would look at your profit and loss in your balance sheet, or you could just do also a budget. So a budget is set in stone, so you do maybe once a year or twice a year you do a budget, then that is fixed for the whole year, and then you can compare your actuals against that. Whereas a forecast every day it sort of could change automatically using software to give your best guess how things are going to pan out over the next few years. Out of these, the most important is cash flow forecast, because it's cash ultimately, or lack of cash, which is the biggest risk to your company. And two aspects, main aspects. That one is, are you profitable? Hopefully yes, but it's no use being profitable if things are not liquid. In other words, you have all your money tied up in stock and debtors and it never gets into cash, so then you don't have the cash available to pay your creditors. So both of these need to be looked at and monitored and tracked. So once you've set these goals, you've got these forecasts and budgets, you have to track your actuals against your budget, against your forecasts, so you can really get a sense of how you're doing against what your plan is. And then that can also help you, give you the motivation you need to take whatever action you need to reach your goals. And then also, once you've got it in place, then, this is all high level, the forecast, then we need to create a roadmap to your goal. Well, it's all always saying you're going to increase your turnover, but how exactly are you going to do that? Are you going to get another salesperson, bring another product or service in, maybe going to upsell to existing customers, maybe you're going to sell to new customers, maybe you're going to open another location. Depending on your industry, there's all sorts of different ways you can achieve that, but step one is to create a roadmap, and then step two is to implement it. And then, as well as focusing on the present and past and future, the next step is to make sure you have the proper monthly reporting pack with graphs, ratio analysis and KPIs, key performance indicators, so you track everything. Every key person gets tracked, their performance gets tracked, and then we would have a discussion every month to just go over this. There's lots of data, so myself and my team would make sure we find the most important data to discuss and make you aware of it, and then they'll give you the information you need to make data-driven decisions. So this is a very important part of what we do. Also, just having someone at the executive level in your organisation can be extremely useful. And there's different aspects of this. The leadership qualities they can bring to your organisation, accountability, and also decision making. Accountability is very important because you've created the forecast and the roadmap, and just knowing that there's someone else who cares as passionately as you do about achieving those goals, then you can brainstorm together, discuss, are you on track, is it going wrong? Having someone else you can talk about these things to is extremely useful, because otherwise it's just numbers on a bit of paper and they don't really mean anything. So that is why these sort of monthly meetings are so important. And in a larger organisation, of course, you'd have board meetings, but maybe in your one it's just you and me, or maybe other decision makers as well. And the other aspect, of course, is decision making. There's so many different possible decisions. You have to make sure you're making the best decisions, and that they have to be driven by data, which I'll be helping provide you, and also just sort of bouncing around ideas. How about this? What do you think about that? And it's sometimes very useful to get someone else's viewpoint, whether or not you decide to go that way or not. At least it helps clarify things, just to talk about it as someone of a similar level, or maybe someone from outside the organisation who can see things maybe a bit more objectively. So these are all very important aspects that a CFO can bring to the table. And so how would this actually be delivered to? What would it look like? Go to my site, redboxfinancial.com. You can see there's some information there, and you see these sort of reports that I would deliver every month. Now this is there's a lot of data, and it might be that some of this is not relevant to you, so I would only present the data that I believe is relevant for you, or data that you specifically asked for. And a lot of these are ratios, or they're comparing with budgets and forecasts or previous years. So it is all extremely important, and early warning indicators of things going wrong. There's like a cash flow forecast, looking at historic cash flow, looking at invoices due, customers who paid the most. There's so many ways you can analyse this data. Profit and loss performance against last month, last financial year. Balance sheet performance, looking at different ratios of cash, current ratios and so on, and for instance current assets is going up and down like that. What's the reason why? Well, maybe that needs investigating. And then there's also information about customers and suppliers. This customer, for example, Four Seasons Hotel, is taking 43 days to pay, which maybe they need chasing. That sounds a bit slow. Also this one, you're 40% dependent on that, which means that 40% of your turnover comes from this particular customer. So you could be exposing yourself to risk. So it's just something you should be aware of. Then this is we send you a PDF like this every month, and also discuss it with you. And it just having this sort of awareness is the difference between moving forward with clarity, making data-driven decisions, and just basically not really knowing what's going on and just hoping for the best. So the former is a much more likely way to achieve good growth and to achieve your goals. And when you don't know what's going on, you're really exposing yourself to a lot of risk, and it's very unlikely, I'd say, that you would reach the same level of success. This is like a brief summary of the sort of thing that the service that I offer. So what I would suggest is, if you go to redboxfinancial.com, there's a little chat box in the corner. You can just fill in a message there. It comes to me personally. I'll reply, and then hopefully we'll be able to jump on a quick call, just bounce around a few ideas and explore whether we're a good fit, and whether or not I can help you, and how I can help you. That's all for now. Hope to see you soon. Bye.